The financial crisis of 2008 was a major global economic downturn that began in 2007 and lasted until around 2009. It was caused by a number of factors, including the collapse of the subprime mortgage market in the United States, a decline in housing prices, and problems in the banking and financial sectors. The crisis led to the Great Recession, a period of economic decline that affected many countries around the world. The financial crisis had a major impact on the global economy and led to widespread unemployment, business failures, and economic recession. One thing that many people may not know about the financial crisis of 2008 is that it was not the first time that the United States had experienced such a crisis. In fact, the U.S. has a long history of financial crises, with the most famous being the Great Depression of the 1930s. The financial crisis of 2008 had many similarities to the Great Depression, including a collapse in housing prices, a decline in the stock market, and a rise in unemployment. However, unlike the Great Depression, which lasted for more than a decade, the financial crisis of 2008 was relatively short-lived, with the global economy beginning to recover within a few years. The global economy began to recover from the financial crisis of 2008 through a combination of government interventions and central bank actions. One of the most significant responses to the crisis was the implementation of large-scale monetary and fiscal stimulus programs by governments around the world. These programs, which included measures such as lower interest rates, increased government spending, and bailouts of troubled financial institutions, were designed to boost economic activity and help stabilize financial markets. In addition, central banks played a key role in the recovery by providing a steady supply of liquidity to the financial system. For example, the U.S. Federal Reserve implemented a number of unconventional monetary policies, such as large-scale asset purchases, to help stabilize financial markets and support the flow of credit to households and businesses. Overall, these measures helped to restore confidence in the financial system and laid the foundation for a gradual recovery of the global economy. Cryptocurrencies, or virtual currencies that use cryptography for secure financial transactions, have been around since the early 1990s. However, it was not until the launch of Bitcoin in 2009 that cryptocurrencies began to gain widespread recognition and adoption. The financial crisis of 2008 was a key factor in the emergence of Bitcoin and the broader cryptocurrency market. The crisis, which was fueled in part by the collapse of the subprime mortgage market and the resulting instability in financial markets, led many people to lose faith in traditional financial institutions and to seek out alternative ways to store and transfer value. Bitcoin, which is decentralized and not controlled by any government or financial institution, was seen by many as a potential solution to these problems. Since its launch, Bitcoin and other cryptocurrencies have gained a devoted following and have inspired the development of numerous other virtual currencies. Today, the cryptocurrency market is a rapidly growing and highly innovative space, with new projects and applications being developed all the time. It is difficult to say whether cryptocurrencies, or any other financial innovation, can completely prevent a financial crisis. Financial crises can be caused by a wide range of factors and can often be difficult to anticipate or prevent. That being said, some people believe that cryptocurrencies and other decentralized financial technologies have the potential to make the financial system more resilient to crises. For example, because cryptocurrencies are not controlled by any central authority, they are less vulnerable to manipulation or interference by governments or financial institutions. In addition, the decentralized nature of the cryptocurrency market makes it more resistant to the kind of systemic risks that can lead to a financial crisis. However, it is important to note that cryptocurrencies and other decentralized financial technologies are still relatively new and untested, and it is not yet clear how they will perform in a crisis situation. It is also worth noting that the cryptocurrency market has its own set of risks and vulnerabilities, such as price volatility and the potential for fraud or hacking. As such, it is important for investors to be aware of these risks and to approach cryptocurrencies with caution. In summary, the financial crisis of 2008 was a major global economic downturn that was caused by a combination of factors, including the collapse of the subprime mortgage market in the United States, a decline in housing prices, and problems in the banking and financial sectors. The crisis led to widespread unemployment, business failures, and economic recession. Governments around the world responded to the crisis with large-scale monetary and fiscal stimulus programs, and central banks played a key role in stabilizing financial markets and supporting the flow of credit. The global economy began to recover from the crisis within a few years, and the emergence of cryptocurrencies and other decentralized financial technologies has led some people to believe that these technologies have the potential to make the financial system more resilient to crises in the future. However, it is important to note that cryptocurrencies and other decentralized financial technologies are still relatively new and untested, and it is not yet clear how they will perform in a crisis situation.